If you want to know how far the market can realistically move today, where your stops make sense, and whether you should be trading mean reversion or breakouts today, you basically only need one single number, the expected move. In this video, I will show you what the expected move is, how it is created, and how we use it very specifically at TradeNeon every single day. Let's get started after the intro. What is the expected move? The expected move is the movement of an underlying over a specific period of time that is priced in by the options market. With 0 DTE, meaning 0 days to expiration, this period is exactly one single trading day. The theoretical foundation is the Black-Scholes formula. Put simply, every option contains an implied volatility, which is the market's expected range of movement annualized. When we scale this volatility down to 1 day, we get the expected move. The simplified formula is expected move is price times implied volatility times square root of time in years. For a single trading day, this means that we divide the annualized volatility by the square root of 252, which is the number of trading days in a year. In practice, however, we use a shortcut that works just as well. The price of the at-the-money straddle is a very good approximation of the expected move. A straddle consists of a long call and a long put at the same strike. The break-even points of the straddle define exactly the range within which the market is expected to move until expiration, with a probability of roughly 68%, meaning one standard deviation. In short, if the SPX closes at 5,800 and the 0 DTE straddle costs 35 points, the market expects a move between 5,765 and 5,835 with a probability of approximately 68%. How we calculate the expected move at LOI. At level of interest, we have introduced the 0 DTE expected move as a new level type. Our process is always the same. We take the 4 p.m. Eastern closing price, meaning the Wall Street close, in parallel for 3 underlyings, the ES future, the SPX, and the SPY. From the respective closing price, we determine the ATM straddle price for the next trading day and plot this value symmetrically above and below the close. This gives us our expected move levels, the range in which the market is likely to move on the following day. And these levels are the foundation for everything that comes next. First, resistance and support. The upper and lower expected move boundaries act as natural resistance and support levels. Why? Because around these levels, market makers have to hedge actively, and gamma and delta hedging create mechanical pressure against the trend. A day on which the SPX reaches the upper expected move boundary has already completed a full standard deviation move. Statistically, the probability that the market will move beyond that level is significantly reduced. So, we treat these levels like horizontal support and resistance lines as a complement to classic volume profile and order flow levels. Second, estimating volatility for the day. The expected move is essentially a volatility forecast expressed in points. In the current market context of May 2026, this means a 0 DTE straddle of 40 points on SPX implies a quiet day. 70 points or more indicate increased movement potential, typically ahead of FOMC days, CPI releases, or NFP. This helps us adjust the daily parameters of our trades. On a 30-point day, we work with higher targets and smaller stops. On a 90-point day, we give trades more room and, if necessary, reduce position size in order to keep dollar risk constant. Early warning signal for market stress. If the market breaks one of its expected move boundaries within the first 2 or 3 trading hours, that is a clear warning signal. The volatility expected that morning was underestimated. We often see days like this after unexpected news or geopolitical shocks. In these situations, we reduce position size or temporarily switch to pure observation until a new equilibrium appears. 4. Trend day versus range day, strategy selection. This is one of the most valuable applications for daily planning. If the expected move is small, let's say 30 to 40 points on the SPX, we tend to expect a range-bound day. In this environment, mean reversion strategies typically work well. fading extremes, trading pullbacks to VWAP, selling volatility. If the expected move is large, on the other hand, 50 points or more, the probability of a trend day increases significantly. In that case, breakout strategies, trend continuations, and long volatility setups make more sense. This simple filter, small expected move equals range day, large expected move equals trend day, sharpens trading strategy selection enormously and helps avoiding the classic trap of trading the wrong system on the wrong day. 5. Fair, undervalued, or overvalued, the Black-Scholes comparison. Our fifth and perhaps most exciting use case, we compare the actual straddle price at 4 p.m. with a theoretically calculated expected move based on the Black-Scholes formula and realized or historically implied volatility. If the market charges significantly more for the 0DTE straddle than the formula suggests, options are relatively overvalued, which supports short volatility strategies such as iron condors or short strangles. If, on the other hand, the straddle appears cheap, options are undervalued and long volatility strategies such as long straddles or backspreads become more interesting. This valuation gives us an additional edge that purely chart-based traders do not have. Let's look at an example. SPX closes at 4 p.m. at 5,800. The 0DTE straddle for the following day costs 35 points, so we get an expected move band from 5,765 to 5,835. Black-Scholes using realized 20-day volatility would give us around 28 points, so the market is pricing in a volatility premium of roughly 25%. Classic behavior before an event day. From this, we draw three conclusions. First, higher expected volatility, meaning wider stops. Second, clearly defined levels at 5,765 and 5,835, which we can use as support and resistance. Third, if the market breaks these levels quickly, immediately become more defensive. This is exactly the kind of structured preparation we do at TradeNeon every single day. The expected move is one of the most powerful tools you can have in your trading toolbox if you know how to read it. At level of interest, you not only get these levels fully calculated, but also placed into the complete daily context. If this video helped you, leave us a like, subscribe to the channel for more trading content, and let us know in the comments which of these 5 use cases you find most useful for your own trading. See you next time and good trades!